we are learning about what is working capital. Okay, working capital of the business. Okay, working capital covers all the current accounts of the firm, that is all the current assets of the business. Okay, now what is current assets? Current assets means raw material stock, then WIP stock. WIP is work in progress. Okay, so this is particularly in the manufacturing industry, wherein there will be some work in progress. Okay, there will be some stock which is yet to be completed in the process, in the machinery. Okay, that is work in progress. At every point of time, there will be some work in progress stock. Okay, then finished goods. This will be in the case of manufacturing industry. Then in case of traders, there will be only finished goods. Okay, then other stocks will be consumables, which will include your stationery and all such miscellaneous stock. This will be in the case of both manufacturing industry as well as in the case of traders. Then there will be sundry debtors, then cash. Okay, there needs to be some cash which has to be kept in the office, cash in hand. Then bank, some amount in the bank account, that is your current bank account. Okay, or some fixed deposits in your bank account, small term fixed deposits. Okay, so all this current assets needs to be maintained. There are certain amount of funds that are required to be tied up in all this: raw material, work in progress, finished goods, consumables, sundry debtors, and cash in hand. Okay, so why? Because at every point of time there is a need of using some of this working capital. Okay, so it's very important to understand what is the concept of the working capital and how to manage the working capital. Okay, so a certain amount of funds automatically available to finance the current assets requirement. We always have to keep a certain amount of fund to finance our current assets requirement. Okay, so let's see what are the types of working capital now. Now let's see what are the types of working capital. Okay, so there is gross working capital. Okay, gross working capital refers to the investment in all the current assets taken together. The total of investments in all current assets is known as gross working capital. That means all the current assets taken together is gross working capital. Okay, so when you total all the current asset, that is nothing but your gross working capital. The next is net working capital. Okay, the term net working capital refers to the excess of total current assets over total current liabilities. Okay, it may be noted that current liabilities refer to these liabilities which are payable within 1 year. So net working capital is all current assets minus current liabilities. Now current liabilities means liabilities that are payable within the period of 1 year. Okay, all these are current liabilities. What are the examples of current liabilities? Your sundry creditors. Okay, for purchases, that is for purchase of goods. Then sundry creditors for expenses, or you can also call it as your outstanding expenses. That is your salary payable, your insurance payable, or any other expense which is payable. Okay, within a period of 1 year. All this comes under current liabilities. So your net working capital is all current assets minus current liabilities. Now let's see what are the types of working capital that can be divided into depending on the point of view of time. How do we how do we differentiate between two types of working capital? Let's see those types. So let's understand what are the types of working capital depending on point of view of time. Okay, from there is permanent working capital. Now permanent working capital also refers to as a hardcore working capital. It is also known as a hardcore working capital. Okay, so this is the minimum level of investments in the current assets that is carried by the business at all times to carry out minimum level of activity. So this is nothing but minimum investment, okay, to carry minimum level of activities. Okay, so this will include what? Say for your business there needs to be some minimum amount of cash that is required daily. Okay, so minimum balance in your cash account. Then there is some minimum balance that is required in your bank account. Then there is some minimum quantity of raw material, WIP and finished goods that is required to be maintained to run your factory on day-to-day basis. So all this, okay, minimum investment to carry minimum level of activities, this is known as permanent working capital as it won't fluctuate. Okay, it will remain constant, okay, throughout the year. So this is on the basis of your daily requirement. Then there is one more, temporary working capital. Okay, so what is temporary working capital? It refers to that part of total working capital which is required by the business over and above permanent working capital. So whatever is the capital which is required by the business over and above your permanent working capital is known as a temporary working capital. It is also known as variable working capital. Okay, so volume of the temporary working capital will keep on fluctuating from time to time according to your business activity. It may be financed from short term sources. Okay, so this temporary working capital, as the name itself suggests, the value of the temporary working capital will keep on fluctuating. Okay, for example, if it's a seasonal industry, okay, so sometimes whenever the demand is more, okay, before that the production will increase, so there the stock which needs to be kept, cash account, bank balance, everything will increase. Even your sundry debtors, sundry creditors balance will increase. So at that time your working capital will increase. Okay, then after that your working capital will come down and it will keep on fluctuating. Okay, depending on your business activity. So this can be financed from your short term sources by planning ki what is the time period for which this amount of working capital is required, and accordingly you can finance it using your short term sources. Okay, you can have some short term loans or overdraft loan from the bank and finance this temporary working capital. Okay, now this graph will show you your permanent and the temporary working capital. Okay, amount of working capital. Now in short period of time, this is short time, okay, say 1 year, okay, your permanent capital will more or less remain constant. Okay, this is permanent capital, whereas your temporary capital will keep on fluctuating depending on your season. Okay, So this is temporary capital. Okay, now if you take a long period of time, let's say for 5 years, okay, if you prepare a graph of 5 years or 10 years, you will notice that your permanent capital will slowly gradually increase. This may be on account of inflation, okay, or increase in the capacity, right? And your temporary capital will be fluctuating. Working capital. Okay, so this is how your graph will look like. Okay, now let's see what are the effects of overcapitalization or inadequate working capital. Now there is some concept known as optimum working capital. Okay, now how to derive this optimum working capital? Now this depends upon the industry to industry. Okay, there may be some requirement for one industry of what is the optimum working capital, whereas there is some other requirement for other industry on how much should be the optimum working capital. So it depends on industry to industry. Okay, so the depending on that analysis of how your industrial activity is, how your manufacturing process is, and how is the demand, okay, you need to set a optimum working capital. Okay, so what will happen if there is a overcapitalization? Okay, overcapitalization refers to the condition in which company has too much large funds for its working capital requirements. Okay, so it has invested a large amount of funds in working capital than required. Okay, so what will happen in such condition is you have blocked your funds. What will happen? You have blocked your funds in the working capital. Okay, so there are chances that your stock may be expired. Okay, excess stock which has been kept may expire. Then there may be some low rate of return since there is no optimum utilization of your resources. Okay, at the same time there shouldn't be inadequate working capital. Okay, that is company has invested less amount in working capital. So if this happens, what will happen is if your stocks are inadequate, then your production needs to be stopped. Okay, because there is no stock, or if there are no cash or bank balance to meet your day-to-day expenses and requirement, then that may affect your business. Okay, that may affect your goodwill also. So it's very important that the working capital, amount of working capital should be optimum. Okay, now let's see one example, okay, to understand and analyze what is overcapitalization and inadequate working capital. So following are the details of working capital required at a particular point of time, okay, in similar industry, and data of firm A and firm B. Analyze the same. Okay, so we are given stock of raw materials, stock of finished goods, work in progress, sundry debtors, cash in hand, cash at bank, sundry creditors, and net working capital. Okay, so now let's analyze the net work. If you see the net working capital, as per the standard, it should be 49,000. Okay, now if you see, look at the data of firm A, then you can see their investment in working capital is 81,000. So there is an over capitalization. Okay, then if you see firm B, the amount is 31,000 as compared to 49,000. So there is inadequate investment in working capital for firm B. Okay, now let's analyze this one by one. Stock of raw material. So standard required is 100 kgs of raw material, but firm A has kept 150 kgs of raw material. Okay, so what is happening? It has overstocked. Okay, this is case of overstocking. It's not 50 kgs additional stock is not required. Okay, as per industrial standards. Again, that depends on industry to industry. Okay, if firm A has got an assignment of additional production or additional sale, then this 150 kgs is justified. Okay, so we need to see the situation. So as of now, in the given situation, this looks that there is a overstocking. What it may lead to? What it may lead to your stock with getting obsolete or expired, or it may also lead to some increase in your losses. Okay, since your stock has been more, there is more maintenance of stock which is required. Okay, now let's see firm B. Firm B 7,000, that is 70 kgs has been kept as a raw material instead of 100 kgs. Okay, so what will happen? Because of this, the optimum quantity of stock is not there, so it may affect your production. Okay, one point it may happen that there is no stock, and so production may get affected or production may get stopped. Okay, next, stock of finished goods. Stock of finished goods is 12,000 or 120 units. But firm A, again there is a overstocking. It has kept 180 units. Okay. Then firm B, it has kept less unit, that is 8,000. 8,000 amount and 80 units. Then work in progress. Work in progress also same. Standard as per similar industries 12,000, whereas firm A has kept 20,000 as work in progress, firm B has kept 16,000 in work in progress. So there will be more increase in your finished goods after some days in case of firm A, okay, which will again lead to overstocking. Then sundry debtors. Sundry debtors, credit allowed in the similar industry for debtors is 16,000. But firm A is allowing more credit. That is why the sundry debtors amount is 18,000 in case of firm A. Okay, so it's again, it's not good, right? Whereas firm B, if you see, the amount is 12,000. So in a way, it's efficiently managing its debtors. Okay, even if it's understocking its raw material, finished goods and work in progress, it's efficiently managing its debtors because its debtors are at 12,000. That is, it is having more of a cash sales, correct? Then cash in hand, again 8,000 is required, whereas firm A is keeping a cash in hand of 10,000 and firm B is keeping a less cash in hand of 2,000. So in this case, what will happen is firm B may not be able to meet its day-to-day requirement. It may affect its goodwill also. Again, cash at bank same. Standard as per similar industries 3,000. Then standard as firm A is maintaining 8,000, that is higher bank balance. So firm A is quite conservative. It keeps higher cash balance, higher bank balance, higher stock of goods. Okay, so it's doing a lot of overcapitalization and misusing its resources. Okay, whereas firm B again is keeping a very less cash at bank at this point of time, so it may affect its day-to-day expenses also. Then sundry creditors. So normal credit allowed by sundry creditors in standard industry is 12,000, whereas firm A, it's not able to negotiate properly with its creditor, so it's having only 8,000. It can get only 8,000 amount of sundry creditors at a point of time, whereas in firm B, it is negotiating very well with creditor and it is managing to get 15,000 credit, okay, from the creditors. So in this way you can analyze each and every item of working capital, and if there is a overcapitalization or inadequate investment in the working capital, okay, you can see where exactly is a problem, okay, in which area, whether it's in stock or debtors or cash or creditors, and accordingly you can rectify it. Again, your working capital requirement need not be as per your standard industry. Okay, it depends on firm to firm also. Okay, as I said, there is a immediate requirement of goods or demand of goods okay, for a certain firm, then it needs to increase the stock of raw material, finished goods, work in progress, or vice versa also. If there is sudden fall in the demand, then it needs to decrease its production. Okay, so it depends on your standard as well as your particular firm or industry also, and the activity of your manufacturing unit, industry, and business. Okay, so this was about working capital and optimum utilization of working capital. Thank you.